Hey everyone, welcome back to Corporate Decoder Today, etc. To not have picked a more telling filing for its exchange-traded concepts, trust, and I'm seeing a pattern that is hard to ignore. Quick note, this is not financial advice, just my take on public filings for educational purposes. These funds, the ROBO Global ETFs, are showing some serious growing pains in their latest shareholder report, and it might be time to look under the hood. Alright, so what exactly are we looking at here? This is a certified shareholder report for Exchange Traded Concepts Trust. This is the parent company for several exchange traded funds or ETFs. What caught my eye is the reporting period ending the 30th of April 2026. This report is basically giving us a status update straight from the company on how their ETFs are performing and what their financial situation looks like. We're going to dive into 3 specific funds today. First up is the ROBO Global Healthcare Technology and Innovation ETF, ticker HTEC. This fund focuses on companies in the healthcare innovation space. Think revolutionary medical devices, biotech breakthroughs, and anything pushing the boundaries of health. Next is the ROBO Global Robotics and Automation Index ETF, ticker ROBO. This one is all about robots and automation, the companies building the machines and systems that are changing how we work and live. And finally, the ROBO Global Artificial Intelligence ETF, ticker THNQ. This fund dives into the world of artificial intelligence, from the chips that power AI to the software that makes it all work. Now let's get into the performance for the year ending the 30th of April 2026. HTEC actually had positive performance, returning 24.45%. That sounds good, right? But here is where it gets interesting. The primary broad-based index it tracks, the VettaFi Full World Index, gained a much higher 31.56%, and the S&P 500 index did even better at 31.05%. So while HTEC made money, it significantly underperformed its benchmarks. The report mentions specific breakthroughs in regenerative medicine and strong performances from companies like Axogen and United Therapeutics. However, challenges in areas like data analytics and medical instruments due to tightening hospital spending and long sales cycles drag down other holdings like Boston Scientific and Integrate Life Sciences. Moving on to the Robo Fund, this one had a fantastic year, returning a whopping 58.93%. It completely crushed the VettaFi Full World Index and the S&P 500. The report highlights strong growth across the robotics and automation space, with companies like Celestica and Teradyne showing standout performance. It seems the world's interest in robotics for everything from reshoring manufacturing to national security is really driving this sector. And the THNQ Fund for Artificial Intelligence also had a stellar year with a 58.87% return. Again, this significantly outperformed the broader market indexes. The report points to strong gains in the semiconductors sector, driven by companies like AMD and Taiwan Semiconductor. Network and security also saw strong performance from companies like Lumentum. It is clear that the demand for technologies supporting artificial intelligence is booming. When we look at how these funds have performed since they started, the picture gets a bit more mixed. The HTEC fund, since its inception in June 2019, has returned an annualized 4.88%. Compare that to the VettaFi Full World Index, which has returned 13.54% annualized, and the S&P 500 at 15.72% annualized. So over the long term, HTEC has seriously lagged. The Robo Fund since April 2016 has an annualized return of 12.63%. This is competitive with the VettaFi Full World Index at 12.93% and the S&P 500 at 15.26%. While not quite beating the S&P 500 consistently, it is holding up much better than HTC. The THNQ Fund, being the newest, started in May 2020. It has shown an impressive annualized return of 19.16%, which is actually outperforming both the VettaFi Full World Index and the S&P 500 since its inception. This suggests that while the sector has been strong, the fund has been particularly good at capturing those gains. Now let's look at some key statistics as of the 30th of April 2026. For the HTEC fund, total net assets were about $53 million. That is relatively small for an ETF. They had 60 holdings and paid out $333,000 in advisory fees. The portfolio turnover rate was 38%. For Robo, total net assets were a much larger $1.77 billion with 79 holdings and $12 million paid in advisory fees. Its portfolio turnover was 35%. And for THNQ, total net assets were $322 million with 54 holdings and $1.7 million in advisory fees. Its turnover rate was 34%. Looking at where the money is invested, HTEC is heavily concentrated in healthcare, making up 95.4% of its portfolio. That is a huge bet on one sector. Information technology is only 1.7%. For Robo, the industrial sector makes up 47%, and information technology is 42.8%. This makes sense given its focus. THNQ is overwhelmingly invested in information technology at 73.1%. Consumer discretionary is 9.2%, and communication services is 7.2%. For HTEC, the top 10 holdings are all in the healthcare space like Axogen, Arrowhead Pharmaceuticals, and Twist Bioscience. For Robo, the top holdings are Celestica, Teradyne, and Infineon Technologies, all in the industrials and tech space, and for HTEC, it is tech giants like Advanced Micro Devices, Nebius Group, and Alphabet. This shows the funds are really sticking to their stated investment themes. Interestingly, for all three funds, there were no material changes reported during the period, which suggests a stable strategy. Let's circle back to the financials for a moment. The total net assets for HTEC are $53,336,595. This is a key number to watch. For Robo, it is a massive $177,102,398.84. And for THNQ, it is $322,418.99. The sheer size of Robo here compared to HTEC is striking. Digging into the statements of assets and liabilities, we see a consistent picture across the funds. For HTEC, total assets are just over $53 million, with liabilities around $320,000. This results in net assets of about $53.3 million. The overwhelming majority of that is in capital, meaning investors have put in about $147 million, but the fund has accumulated losses of over $93 million. This is a big red flag for HTEC right here. Now let's look at the statements of operations for HTEC. Investment income was only $265,000, but expenses were $333,000. That means the fund lost money on its operations before considering investment gains or losses. The net investment loss was over $67,000. They did have realized gains of about $604,000 and unrealized appreciation of over $9 million, leading to a net increase in assets from operations of over $10 million. But that operational loss is concerning, especially when you compare it to the massive net assets of the Robo Fund, which shows investment income of over $14 million and net investment income of over $2 million. The financial highlights further paint this picture. For HTEC, the net asset value per S-Hair at the beginning of the year was $27.05 and it ended the year at $33.34, which is a good increase. However, the net investment income loss per S-Hair was negative $0.04. The total return on net asset value was 24.45%. Matching what we saw earlier, but look at the expenses ratio, it is 0.68%. That is not terrible, but when you combine it with the operational losses, it adds up. For Robo, the net asset value per S-Hair started at $51.04 and ended at $80.78, a huge gain, and its net investment income per S-Hair was positive $0.11. Now, the notes to the financial statements are crucial. Under organization, it states that Exchange Traded Concepts Trust is registered under the Investment Company Act of 1940. It also mentions that the ROBO Global Artificial Intelligence ETF is classified as non-diversified. This means it can invest a larger portion of its assets in fewer companies, which can amplify both gains and losses. This is important to remember for THNQ. The security valuation section is standard for any fund report, explaining how they value their holdings. They use quoted prices in active markets when available level 1, quoted prices that aren't active or observable inputs level 2, and unobservable inputs level 3. For these funds as of the 30th of April 2026, all investments were considered level 1, meaning they are valued based on readily available market prices. This is a good sign showing transparency. Under service providers, we see the investment advisor is Exchange Traded Concepts LLC. They get paid advisory fees based on a percentage of the fund's assets. For HTEC, it is 0.80%. For Robo, it is 0.95% on the first $2 billion of assets, and then it decreases. And for THNQ, it is 0.75%. The advisor has agreed to waive a portion of its fees for HTEC and THNQ to help boost performance. For Robo, the fee structure is a bit more tiered. These waivers are important because they directly impact the net returns to investors. The investment transactions section shows the buying and selling of securities. For HTEC, purchases were about $18.5 million and sales were $19.2 million. For Robo, purchases were a massive $492 million and sales were $447 million. And for THNQ, purchases were $92 million and sales were $88 million. This indicates a lot of trading activity, especially in the Robo Fund, which is typical for an actively managed ETF or one that tracks an index that rebalances frequently. The tax information section provides details on how distributions are taxed. For HTEC, all distributions were classified as ordinary income. For Robo and THNQ, they also had ordinary income distributions. This is important for investors when filing their taxes, and it also mentions capital loss carryforwards for all three funds, indicating past losses that can offset future gains, which is common in equity funds. Now let's not forget about the risks. These are crucial for understanding what you are investing in. For HTEC, the primary risks are currency exchange rate risk, foreign securities risk, geographic investment risk, market risk, and specifically healthcare sector risk. This means that HTEC is heavily exposed to the ups and downs of the healthcare industry and global economic shifts. For Robo, in addition to some of those general risks, it has industrial sector risk and information technology sector risk. For THNQ, it also carries information technology sector risk. And importantly, for THNQ, it is flagged as a non-diversification risk. This means THNQ can invest a larger percentage of its assets in fewer companies. So if one of those key holdings falters, the whole fund can take a big hit. Interestingly, the Robo Fund engages in securities lending. This is where the fund loans out its securities to borrowers, typically for a fee. This can generate extra income for the fund. As of the 30th of April 2026, the fund had over $139 million in securities on loan, with $75 million in cash collateral. This is a common practice for ETFs, but it is good to see it detailed. Finally, the report of independent registered public accounting firm from Cohen & Company Ltd states that the financial statements present fairly, in all material respects, the financial position of each fund. This gives us some assurance about the accuracy of the numbers presented. So what is the story here overall? The Robo and THNQ funds are showing strong recent performance and good growth. However, the HTEC fund is a different story. Despite positive annual returns, it is significantly underperforming its benchmarks long-term and shows operational losses. The massive accumulated losses in the statements of assets and liabilities for HTEC are a serious concern. While Robo and THNQ appear to be performing well within their volatile sectors, HTA's fundamental performance and its heavy reliance on a single sector with significant challenges present a more precarious outlook. That is my take. Stay decoded. If you want the broker and charting tools I use, they are linked below. Grab a free sign up if you want to support the work.